If you're 60 or even 70 and you're planning on selling your paid off house to save money in retirement, you are about to sign yourself up for a $92,000 disaster in the first 5 years. The conventional wisdom about downsizing is a lie. It comes down to 3 hidden costs that no one talks about. It's not just realtor commissions that will cost you 5 to 6% right off the top to sell your house, but we're talking about transfer taxes. And some states charge thousands to transfer ownership. Then on your new house, you got inspection fees, you've got appraisal fees, you've got attorney fees, you've got title insurance, title search, title work. It all adds up. And then there's the actual cost of moving. You got to hire movers, a truck, people to pack your furniture and your belongings, move wherever you're moving. It could easily cost you $5,000 to $15,000 just to move from one house to another. But the really sneaky one is the capital gains exclusion trap. Many retirees bought their house years ago for peanuts. You can exclude $250,000 if you're an individual and $500,000 if you're a couple. And that sounds a lot, right? But if your gain is $600,000, that is $100,000 on the capital gains and taxed at 15 to 20%. That's another $15,000 to $20,000 going to Uncle Sam. And then there's state income taxes as well. So before you even unpack the box, pack the box, you are already costing yourself anywhere from $30,000 to $60,000 before you even get settled into your brand new house. But that's just the initial hit. The second point of costs that are hitting retirees huge in the back pocket is a cost that they never had to really deal with, and that is the new cost of living. So the plan is in motion. You decide to move to another state, cheaper state, or downsize to a smaller home, and you think the expenses will just plummet. And on paper, your new house is cheaper. The reality is far more insidious. Because what happens when you buy that cheaper home in all cash? You're hit with new property taxes based on the new inflated values. Your old homes might be locked into a much lower property tax, especially with homestead exemption. Your new home, though, that's a whole new value based on today's price that you paid for the house. And then there's the elephant in the room, homeowners insurance. Coastal areas or even storm or flood prone states have seen insurance premiums double, triple, or even quadruple in the last couple years. So you might have paid somewhere around like $1,500 for your old home for insurance. But now, because of your new home, you're looking anywhere from $4,000, $5,000, even $8,000, depending on if you're in a flood zone or if you're, prone to high winds from hurricanes. That's thousands of dollars that you did not budget for. So while you got rid of that mortgage, now you don't have a mortgage payment, free and clear. You just added $500 to $1,000 a month to your expenses between property taxes and insurance every single month. That's a huge bite out of your fixed income. This leads us into the biggest financial anchor for retirees, the loss of inflation hedge. This is the big one. This is where that $92,000, maybe even more, disappears over your retirement. When you sell your paid off home, what are you actually doing? You are taking your most valuable, most reliable, most tax advantaged asset and converting it to cash. Your home is an inflation hedge. Its value rises with inflation, protecting your wealth. When you sell, that money has to go in to an investment or a bank account or some kind of savings account to outperform inflation. And that's just to stay even. Inflation is anywhere from 3 to 5%. That means your cash is losing 3 to 5% every single year. So your home worth around $500,000 might have grown to a value of $650,000 tax-free. Your $500,000 in cash, if you sell, now has a net worth of $400,000. That's a $150,000 swing before we even considered the costs and fees that we discussed earlier. That's where the $92,000 mistake comes from. You traded an appreciating tax-protected asset for a depreciating taxable liability. So, if selling is a trap, then what's the simple solution? If you need access to your home's equity, there are far smarter ways than the selling. And here's the smart move you should make right now. Instead of selling, consider a reverse mortgage credit line or a HELOC, a home equity line of credit. These both allow you to access your home's equity, often tax-free, without selling your appreciating asset and triggering all these hidden costs. You retain ownership and inflation hedge. Now, if your only reason to move is to escape high costs, you need to know the states and even the neighborhoods you need to move to for it to be a financial win. If you found this video helpful, hit that like and subscribe button. Let me know how I can help you out and be a resource to you. My name is Mike Fiebernitz, REMAX Southern Shores. I've been doing this 15 years. I'm here to help. See you guys in the next video.